Hello students and a very warm welcome to this question on share capital. This question is called Roosterbooster. So question 2 says that Roosterbooster Limited need your assistance in processing general journal entries for the year ended 28 February 2016. The company was first incorporated on 1 March 2012 and has the following authorized share capital. Please notice the use of the word authorized, which is the maximum. It's not necessarily the total amount that is out and available to be purchased. It's just the maximum amount that's allowed to be issued. They tell you that there's 500,000 ordinary shares, there's 200,000 convertible preference shares, and then there is 150,000 10% redeemable preference shares with no par value. On 1 March 2015, Roosterbooster had the following in issue. So these are now the shares that are in actual fact circulating. They say that there is 350,000 ordinary shares at a total value of 910,000. Then there's 50,000 convertible preference shares with 300,000, and then there's 100,000 redeemable preference shares amounting to 550,000. Then for the year ended 28 February 2016, they say that on 1 July 2016, the directors issued the remaining authorized ordinary shares to Complex Limited, and this is the first time that shares are being issued to a legal person. They paid R2.70 per share. So they say the remaining ordinary shares need to be issued. So the maximum that is allowed is 500. They have already issued 350. So I believe that Complex, and I'm just going to make a note for myself, they have purchased 150,000 shares. And it's the first time that a legal person has purchased shares. Why is this information important? Because with regards to the dividend, we only pay dividends if we are natural people. Therefore, Complex will not be required to pay dividend taxes. Then on the second additional note there, they say on 1 October 2015, 15,000 of the convertible preference shares were bought back from the shareholders at a cost of 8 Rand 50, I beg your pardon. And then in number 3, they say a dividend was declared on 1 February and the ordinary shareholders received 85 cents for a share. In number 1, it is required for you to do the general journal entries for the issuance of the shares. In number 2, you need to do the general journal entries for the buyback of the preference shares. In number 3, you need to prepare the journal entries for all the dividends. And in number 4, the statement of changes in equity is required. All right, let's start with number 1. For the general journal entries, we need to do for the issuance of the shares. We know that there's 150,000 shares that were in issue. So here I'm then going to indicate my debits and my credits. Debits, credits. And I'm going to say the first step is the application and allotment. So I'm going to say bank. I debit the bank, I credit application and allotment. And here the amount will be the total amount that was received, which is 150,000 times R2.70, and the debits and the credits must be equal to each other. In the second step, we need to go and then recognize the share capital. They only applied for 150, which was the maximum, not for more, so there's no bank repayments. So I'm just going to say I debit the application and allotment. I then credit the ordinary share capital. And again, this amount will then be the 150,000 times R2.70 that was mentioned in the question. And that is then the required part for number 1. In number 2, it is required for us to prepare the journal entries for the buyback. And we know that there's always a trick with buyback. A portion will come from the retained earnings. So they've bought back the convertible preference shares. So I already know I'm working with then the convertible preference share capital. I'm working with retained earnings. and I'm working, if I can ever spell correctly, and I'm working with bank because I'm making a payment. So out of the bank, I credit an amount that I'm paying them, and the question tells me that I paid 8 Rand 50 for 15,000 shares. So 15,000 times 8 Rand 50, that will decrease my bank by 127,500. I need to go and figure out what one convertible preference share is worth, because the amount that it was originally issued for will come out of the share capital. The amount that is excess to the original price will come out of retained earnings. So here I'm going to see the convertible preference shares. They say 50,000 is worth 300,000 Rand. So if I'm going to say, in an additional calculation, 300,000 divided by 50,000 shares, one share is worth 6 Rand. So I'm going to take out the 6 Rand times the 15,000 shares I believe they are buying back there, and I'm going to say the 6 Rand will come out of the share capital. The excess is then 8 Rand 50, up to 8 Rand 50, which is 2 Rand 50. So I'm going to say 2 Rand 50, the remaining excess, times the 15,000, then gives me 37,500 Rand. So please remember, the 6 Rand that it was sold for comes out of the capital, and the rest comes out of retained earnings. You will notice that the retained earnings and the share capital is both a type of equity, and therefore amounts will lesser it. It will become less on the debit side. We are on required number 3, and in required number 3, they've asked you that you need to determine the general journal entries for all the dividends for the current year. So now we need to go and do calculations, and let's see then what it is that we end up with. I'm going to do calculations for the different types of shares so that you can clearly see how I got to my answers. Right, so for the ordinary shares, I'm going to say I was given an amount firstly, then there was an amount to Complex Limited, and then I'm going to get to a total. So here the ordinary shares at the beginning was 350,000. I had to issue 150,000 to a Complex. Just move that to the right aisles. 350 was given, 150,000 to Complex. The total in issue is 500,000 at the end of the year. I need to multiply then by the dividend. So I'm going to say the dividend was given to me as 85 cents. It's then the total of 500,000 shares times 85 cents, and the total dividend is then 425. I'm going to put that in a block, 425,000. Then for my first type of preference share that I see, if I look at my listing, in my question, the first type I see is convertible, but there had been no changes. There have been changes made to the convertible. They've been brought back. The redeemables had no change to them. So for the convertibles, I'm going to say that the calculation is then I start with the given amount, and you will see that at the beginning of the year there was 50,000 of them, and then 15,000 were bought back. So there was already 50, and then the bought back was 15. So I know when I'm working with a preference share, I need a timeline. So here I'm going to say at the beginning I had 50,000 shares. I'm going to times it by the return. The return on these shares was given as 15%. So it's 15% times then the value of the convertible share. We determined that the value of one of them was 6 Rand. And then I need to go and see the number of months, because I had 50,000 up till the date of 1 October, I believe, when they were now bought back. So I'm starting to count from March. It's March, April, May, June, July, August, September. October I will not include in my calculations, because on 1 October it was purchased. It's the first day. So that was 7 months that we had 550,000 for, I beg your pardon. Then we bought back 15. So if I go and say that the 50,000 minus the bought back of 15, leaving with 35,000. So I'm going to say 35,000 times the return of 15% times 6 Rand times my remaining number of months, which is 5 out of 12. And now in doing that, I can go and calculate the dividend. So it's the 50,000 times the return times the 6 Rand that it cost times 7 divided by 12, and then I'm going to add the other part of the year, which is 35 times 15% times 6 times 5 out of 12, which gives me 11 or 13,000, I beg your pardon, 125. So the total for the dividend on the convertibles is the sum of those two, and it gives you 39375. Then I am on calculating the redeemables, but those are easy because there was no change. So for the redeemables, I'm simply going to say at the beginning of the year, there was a total amount of 100,000. There should still be 100,000, and the price should be 5 Rand 50, because 550,000 divided by 100,000 is 5 Rand 50. So that's a calculation for the entire year. It's then 100,000 shares times their return. You will find that the return there is 10%, times 5 Rand 50 times the entire year, and that will give me a dividend answer of 100,000 times 5.5 times a return of 10%, times 12 out of 12, which is 1, and that gives me 55,000 Rand that I need to go and put there. Alright, I now can do my journal entries. My journal entries will then be that I debit the dividends declared. I will credit the shareholders for dividends. And I will also create a SARS dividend tax account. Right, the dividends declared is easy. It's then the sum. So it's this one plus that one plus the total for ordinary shares. We need to calculate the dividend tax. So they say that the only one that has a amount of legal persons is the ordinary shares. So for the ordinary shares, we need to go and see how many shares are held by Complex, and I believe Complex purchased 150,000 shares out of the total 500,000, which says that 30% belongs then to legal persons, which means that 70% is natural persons. So if I should calculate the dividend tax, then I'm going to say the dividend tax is then on this amount 425 times 20% times 70% for natural persons. The dividend tax on the convertibles will be this amount times 20%, which is the standard 20% dividend tax payable in our country. They don't necessarily have to tell you the 20%. You need to know the dividend tax in South Africa is 20%. That's where I get the 20 from. And then I'm going to times that by 1 because it's 100% natural persons. And then 55,000, I'm going to times that by 20% and also by 1 because it's 100% natural people. So in calculating then my credit, I'm going to add the dividend taxes together in this instance, and then the shareholders for dividends is simply calculated as the difference between the two accounts, which is 441,000. The shareholders for dividends, it's a liability account, therefore we increase the liability account there. Right, we are then on the required part number 4, which says that you need to prepare the statement of change in equity. here I need to go and first jot out my layout. I'm going to open a new sheet for this. Right, so I'm going to say I have ordinary shares. I need to first start with the proper heading. Let me just say this. This was Roosterbooster. And just type the proper name and the year end of the statement. So I'm going to say it's a statement of change in equity. And it is for the year ended. And they've given me the date in the required part. 28 February 2016. 28 February 2016. And I'm going to say I have ordinary shares. I have then my convertible preference share capital, and I have redeemable. Then I will also add, typically in a question like this, I will typically add, of course, my retained earnings, but in this question they've not given us enough information with regards to retained earnings. And then we also put revaluation surplus as one of the important columns. Please refer to the template if you don't know what I'm talking about. It's posted to Futela. Then there's an opening balance. There should be a profit for the year, which we don't have. Then there is a dividends declared. I'm just going to increase the size here. There we go. Right, then there should be a issuance. There should be a repurchase. There might be a conversion, but there was no conversion in this question. And we also need a closing balance. There might be a revaluation surplus if they've given you revaluation information. This one you can also call reserve, revaluation reserve. Right, the opening value for the ordinary share was given to us as 910,000. And then the others were also given to us, so I'm typing those in. I think the convertibles were 300,000, and then there was also 550,000. They have not given us the retained earnings. They have not given us the revaluation reserve. The profit for the year was also not included in this question. There was dividends declared, definitely, that I will deduct from retained earnings. And it's then minus the amount of my journal. So my dividends declared was 5193.75. It's going to be that dividends declared amount. The issuance we've also calculated, and you will agree with me that in the previous sheet we said that the share capital has increased by 405. So I'm going to indicate that with a 405 increase in ordinary share capital. There was a repurchase that we've calculated. The repurchase said we minus 90,000 from the capital and we minus 37,500 from retained earnings. So I'm going to say for the repurchase minus 90 there, and out of retained earnings minus 37,500. There was not a conversion in this question, and then you can calculate your closing balances then based on the information that you have. You will observe, of course, then we won't have proper answers for retained earnings because we do not have all the information. But that is what the statement of changes in equity would have looked like in this question if you had attempted it with the information that was available. Thank you so much for watching this video. I hope that it has helped you a bit to understand how to answer share capital questions, and I will also be posting other questions on other topics. Thank you for watching. Goodbye.